بسم الله الرحمن الرحيم. الحمد لله رب العالمين، والصلاة والسلام على أشرف الأنبياء والمرسلين سيدنا محمد وعلى آله وصحبه أجمعين. Dear brothers, Assalamu alaikum wa rahmatullahi wa barakatuh. I would like to welcome you all to ERTI Research Seminar Series. We are glad today to have Dr. Dawood Ashraf to present his research paper. The title of the presentation is Does Islamic Equity Investment Offer Hedging Benefits? Before we start the presentation, let me introduce Dr. Ashraf briefly. He is currently a senior researcher at ERTI. Before that, he was assistant professor of finance and investment at Prince Mohammed bin Fahd University in Saudi Arabia. Dr. Ashraf holds a PhD in banking and finance from University of Wales in the UK and Master of Economics in International Business and Economy from Kyushu University, Japan. Dr. Ashraf's research papers have been published in international journals, and he has presented his research work in various international conferences. Dr. Ashraf will present for about 30 minutes. After the presentation, we will have question and answer session. Now, I would like to invite Dr. Ashraf to deliver his presentation.
Thank you very much, Brother Abdullah, and thanks for your nice words. So, inshallah, I will try to keep the 30 minutes limit. So, hopefully, I'll be able to finish that before on time. So, the topic that I'm going to present today, basically, the reason for this research came out after the 2008 crisis. There was a lot of talk, and we see in the popular press a lot of claims that if you invest in the capital markets using the screening standard by Sharia compliant screening standards, your return would be better than return of the conventional portfolios. So when we read all those claims, we thought maybe let's give us a try and see whether those claims are statistically valid or not. So the basic motivation for this paper came from those popular claims, and thereafter we move into this project. Before I get into the actual nitty-gritty of the paper, just to keep all of us on the same footing, I would like to give you some basic ideas about what Sharia compliant equities are and how they are different from the conventional equities. So investment in public listed companies are allowed subject to the conditions that companies business operations and management complies with the principles of Islamic jurisprudence Sharia. So if it is if a corporation's business, its operations and the management, they all comply with the Sharia standard, so it is allowed for Muslims to invest in those companies. But unfortunately, if you look at the current capital market, maybe we would not be able to find any company at all that can be complied with the Sharia standard, the strict Sharia standards. So because of that reason, there are some exceptions being allowed by the Sharia scholars. And the reason for allowance of this exceptions basically came from one major reason, that the equity investment is kind of a new phenomenon to Islamic finance. And there are no specific guidelines available directly from Quran or Hadith or Ijma. So not having a direct reference from these three major sources of Sharia means we do not have, as a Muslim, we do not have the single interpretation of the rules. So what left is basically the Sharia scholars, they used their own qiyas. So qiyas basically is an analogy that Sharia scholars use based on the historical rulings, so similar rulings. So they take a historical ruling and based on that historical ruling see how how much resemblance we have in that ruling with the situation on hand. So now this qiyas is basically an individual's analogy, or it may be a group's analogy, so it cannot be uniform. So people can differ from one another on this qiyas, and that has resulted in several different Sharia screening standards. So rather than having one single Sharia screening standard, we have in the market several different Sharia screening standards. So say for example, if I give you an example, we have seen recently there are at least 9 to 10 different Sharia screening standards in the market, and people are using those standards. So having different Sharia screening standards has different implication for the portfolio construction as well. So we have to see what are the exceptions, and the different Sharia screening standards basically use a different screening criteria based on the exceptions allowed. So these exceptions that is being allowed by the Sharia scholars for screening of equities to be Sharia compliant basically are in 3 categories. So the first category, the exception is the main business of the corporation. So the Sharia scholars say that if the main business of the corporation is in compliance with the Sharia, like it's not a bank, it's not an alcohol producing company, it's not engaged in the trading of alcohol, pornography and all those kind of things. If it is not engaged in that kind of business, it is allowed to invest in that. But sometimes company, their main business is not haram, is not impermissible, but a portion of it could be haram. So say for example, if we take the example of hotels. So if a hotel is just providing rental accommodation to its patrons, there is no problem with the Sharia on that. But if the same hotel offer on its premises alcohol to its patrons, so then that means a portion of income for this hotel is coming from the income of alcohol. So now for this company, if we go with the very restricted Sharia definition, then we should not invest in that company. But Sharia scholars say that if 95% of the income of this specific hotel is coming from the rent of the premises, Muslims are allowed to invest in that. So that means there is a cut-off at 95%. So the income of a corporation should be at least 95% halal, from the halal sources. Then the second restriction that is given in the financial leverage. So as we all know that Muslims are not allowed to invest or borrow based on interest. Riba is completely forbidden in Islam. So now if a corporation borrows money for running its own operations, if we go with the very restrictive definition of Sharia, we should not invest in those corporations that borrow money. But we know that the present corporate structure the capital structure is like that. If a corporation is not borrowing money, most probably it will not be able to survive for a very long time. So for that reason, the Sharia scholars has allowed that you can, as a Muslim, invest in corporations if the financial leverage of that company is below 33%. So if a company is borrowing more than 33% of its asset or its equity, then in that case you could not invest in those companies. But if it is less than 33%, you're allowed to invest in that. And similarly, if a company has investments more than 33% of its assets earning interest, so you're not allowed to invest in that companies either. And the third item for which the exceptions is allowed is the investment in real assets. So as we all know that Islam does not allow investment in pure financial assets. So for a corporation to invest in, we should invest in corporations those have all assets as real assets. But again, we know that not companies have all assets in real assets. So we allow the companies, the Sharia scholars has allowed the companies to invest, has allowed the Muslims to invest in those companies that have their real assets more than 66% of their overall capital structure. So now with all these exceptions, another issue came out, which is whether the income that you are deriving from the from these investments, whether after these exceptions the whole income is halal or haram. So the Sharia scholars has mentioned that if you are drawing income from those corporations which are not fully Sharia compliant, but those corporations, whatever dividend that you receive as an investor, you should cleanse it. So cleansing means you will take out the proportion that you may consider as interest from that income, or from the haram sources. So cleansing means you will take out that income and then give it as a charity. But remember, this charity has you cannot use it as zakah, or you cannot consider it as that you're doing it for the sake of earning hasana. So this charity is you're just cleansing your mal basically. So now when I look at when we look into this process now, so there are now basically two levels of screening involved on practical side. So first level of screening is you will try to determine whether the business is the major proportion of the business is halal or haram. And the second is you will determine based on the financial leverage, based on the investment in financial assets, based on investment in real assets, whether the company is compliant with Sharia or what not. So we call this as the qualitative screening and the quantitative screening. So in the qualitative screening, you look at the overall structure of the overall nature of the business, and with the quantitative screening, I'm sorry with the tongue twister. So the quantitative screening, we use the different ratios, the 1/3 rule, as I mentioned here. So we have another problem here, that what should we use to determine the 1/3 or the 2/3, whatever the rules we are using? What should we use for that? What should be the basis for that? So you can use, as the Sharia scholars has allowed, that you can use either the total asset, the book value of the total asset, as the denominator for calculating these ratios, or you can use the book value, market value of the equity, as the denominator to calculate these ratios. Now the people who use the book value of asset as denominator, they believe that as a Muslim investor, you are investing in a company as a shareholder, and you are investing it for long term. So you are not speculating on the short term return, you are rather investing long term. So in that case, the book value of the asset should be more suitable to determine the capital structure of the firm. However, the other people believe that the market value basically reflects the actual value of a corporation at a given point of time. And it takes into consideration not only the book value of the assets, but it also takes into consideration the future earning potential of the company as well. So keeping in view both views, they believe that using the market value of equity would be a better denominator for calculating all the financial ratios. But I should mention here one point, that if you are using the book value of total asset as a denominator for determining the Sharia compliance status of any equity, you have to understand one point here, that you will most probably receive your financial statements of a corporation quarterly. That would be the highest frequency that you can see. Most probably for most of the equities you will receive once a year. So for those, if you are using the book value of the total asset as the denominator, your rebalancing would be once a year. So once a year, if you're managing a portfolio, only once a year or maybe 4 times a year you have to determine whether the equities are Sharia compliant or whatnot. But if you are using the market value of equity, and unfortunately or fortunately the data is available per second, so you can determine in every second when the market is open whether the equity is Sharia compliant or whatnot. But that entails higher cost as well. So if you are manager of a portfolio of a mutual fund, that means every second you have to determine whether this equity is Sharia compliant or not, and you will be trading. And we know that the trading has its deadweight cost. So you will be incurring a lot of cost for trading. Okay, so we'll go into practical issues a bit later, but let's move on to see what basically. So this was basically the background for understanding what are the factors that we use for screening of equities. So now I'll take you into the actual paper. So basically what we did in this paper, as I mentioned to you, that the popular claim, and then we look into the empirical evidence in the recent publication, then we find that investment based on Islamic Sharia principles providing a hedging benefit during the downturn of the capital market. So the hedging benefit as defined in the literature is when the market goes down, if you are having 2 portfolios, then a portfolio, if market goes down and the return of that portfolio doesn't go down as much as the return of the conventional portfolio, you will say that the portfolio that you have used, the screen portfolio, is providing you the hedging benefit. So what we see in the recent literature, that there are evidence that if you invest in Sharia compliant equities, you will have the hedging benefit. So you can see the study of Abdullah et al. 2007 from Malaysia, Ashraf 2012 for Saudi Arabia, Saiti et al. 2014 for Malaysia, Ashraf and Muhammad for international evidence. However, when we deeply looked into it, we see that the outperformance depends on the time period chosen for the evaluation. So this was, and the benchmark used for it. So the outperformance of Islamic portfolios was basically dependent on the time period chosen for the analysis, for the empirical evaluation, or the benchmark used for the empirical evaluation. So if you took one benchmark and used another benchmark, you might see that the outperformance does not exist. And similarly, if you took another period, you will see that you will find that the outperformance that is showing for period maybe 2000 to 2004 doesn't exist for 2005 to 2008. So that we found as a weakness in the literature. And then we look further into it, we see that the literature documenting the hedging benefit, authors identify a specific period as a crisis period and draw their conclusion based on that period. We believe that such an approach lacks the rigor, as market fluctuations are common and often observed rising the bull phases or declining the bear phases in the market. Another thing that we have seen, that people in the empirical literature that we observe, that the instruments used to evaluate the performance are either mutual funds or the market or the Islamic equity indices. Now with the mutual funds, these are Sharia compliant mutual funds. I'm not going against it, but when you are using a mutual fund and the manager is applying an active management strategy, so that means this manager is using its own discretion from the available universe of equities. If he feels one equity is going to perform better tomorrow, he might overweight it over the index. Or if he feels that this equity may not perform better in the future, he might completely take it off and have a zero weight in the portfolio, but in the index it might have some value. So now based on that, the manager is all the time using two skills basically. He is using the stock selection ability and he is using the market timing skills. So when he is using the market timing and stock selection ability, the return performance cannot be attributed to Sharia screening standard. So the overperformance that we have observed in case of mutual funds, a part of it can be attributed to market timing and stock selection ability of the fund managers. Now, if I'm trying to understand the behavior of a portfolio based on Sharia compliance standard, I cannot use mutual fund to say that this mutual fund overperformance is attributed to the Sharia screening standard. So people use a different tool, a different instrument, which is Islamic equity indices. Now Islamic equity index indeed much better than the Islamic mutual funds, but the problem with Islamic equity indices is there are different index construction methodologies used. So say for example, if you are comparing the performance of Dow Jones 30 with some of the US based equities, so if the Islamic equity index is constructed based on the market value based, so its performance could be very different from Dow Jones 30, which is a price index. So again, you cannot attribute the performance of Islamic equity index to the Sharia screening standard. So keeping in view all these problems, we decided to take a bit different approach. So we want to deal with the two issues. We don't want to have in our analysis the market timing and stock selection ability of the fund manager, and we don't want to have the issue with the index construction methodology and rebalancing and all those kind of things. So we used a different criteria. So we construct our own Sharia compliant indices, starting with selection of equities from the indices. We used financial screening, we used business screening, So for the business screening, we got data from the ideal ratings, and all the financial screening, as I mentioned to you previously, we did it ourselves. And we construct all the indices. I will mention in a bit later. We constructed all the indices with one single methodology, which is proposed by S&P, mathematical methodologies. So using this method of constructing Sharia compliant portfolio, we got the benefit. We do not have the survivorship bias. We're using the same asset universe for the benchmark and for the portfolio, and we are using the same methodology. So this way, we are trying to have the Sharia compliant portfolio and the conventional portfolio at the same footing. So now, if we compare the performance of these two portfolios, we can say that if underperformance or overperformance of Sharia compliant portfolio can directly be associated to the Sharia screening standard. So we don't have to look for anything else. And as I mentioned to you earlier, there are different screening standards. So maybe we thought a different screening standard might have a different value, may have a different impact on the performance of the Islamic Sharia compliant portfolio. So we used three different standards. We used IOP, which is the standard by the Islamic accounting body. Then we take the Dow Jones and MSCI. So all three standards are different in terms of their denominator. IOP and Dow Jones, they use the market value of equity as the denominator, while MSCI use the book value of total asset as the denominator. Well, IOP use for screening the 12 months trailing average, while Dow Jones use the 24 months trailing average to determine the compliance status. So since we have used our own indices and benchmarks, so we used a methodology which is standard, which from the S&P mathematics methodology that use basically the market value of market capitalization as the determination for the value of indices. We constructed portfolio based on 5 markets from US, Canada, Europe, GCC, and Japan. In total, we took 1,712 equities and constructed 15 portfolios, 3 for each standard and 5 benchmark. So 5 portfolios for each region, each standard, and 5 benchmark portfolios for each market. We use the data from 2005 to 2013, but for Dow Jones standard, since we are using the 24 months average return, so we have to drop the 24 months observation. So basically the data that we have used for analysis is 2008-2013. We could not go back any further than that because most of the data for GCC countries were not, most of the equities data for most of the GCC countries were not available before that time. So that's why we are restricted to this period. We took all the financial data that we have used in this analysis from Bloomberg. So the price of equity, the leverage, the value of the real assets, and all those kind of data we took from the Bloomberg. So basically we asked 2 questions. We ask ourselves whether the return of Sharia compliant indices does not fall as much as the market of benchmark indices during the downfall of capital market. Basically, we try to understand whether there is a hedging benefit for investment in Sharia compliant portfolio or whatnot. And second question we asked, and the reason for the second question is we thought that if we are applying the market value of equity, that means if an equity is performing worst, the market value of equity, in using the market value of equity approach, we will take out those equities, those are performing bad, as early as it is in compliant with Sharia standard. And if so that means we are using basically a bit of the market timing skill incorporated in the standard itself. And secondly, if the market is going up for a specific stock, so maybe there is a possibility that with the standard that is using the market value of equity as a basis for determination of Sharia compliance standard, it will pick up an equity earlier, and then we might get the benefit of investment in those equities. So based on that, we took our second hypothesis that basically we try to see whether the Sharia compliant indices following the market value approach provides better hedging benefit as compared with those following the book value approach. So I'll give you a little bit sense of the data. And if you see here, as I mentioned to you, we took the equity level data for 5 indices from 5 different regions. And if you see here, the total number of equities that we have for the USA, 500 equities for USA, 60 for TSX Canada, 350 for Europe, 302 for GCC, and about 500 for Japan. And based on that, if you see that how many equities are Sharia compliant in percentage, and we see that in most of the cases, more than 40% equities are Sharia compliant. So that means if you are investing in any of these indices based on Sharia compliance, you will see that you will not lose a lot. You lose more than 50% in some cases, but you will not lose a lot. So you will have more than 40% equities available to you for investment, and if you are using the law of large numbers, you have more than 30 equities in any case, and that means that your diversification loss could not be as much as we usually thought about the investment in the Sharia compliant indices. And if you look at the descriptive stats, I'm not showing the tables. I know that it's very hard to read from these slides, so I'll just give you the gist of the results that we have derived from the descriptive statistics. We see that no two Sharia compliant indices have the same number of constituents. More companies pass the filter based on the book value screening, MSCI. IFE looks like the strictest standard. It is more sensitive with the market as well. And we see that the GCC Sharia compliant indices has financial sector as well, because there are banks in this sector that are Sharia compliant. While we have completely screened out the sector, the banking and insurance sectors from other regions. So I want you to look at this picture, and you will see that, especially in the 3 markets where you see the blue arrows, and you see that for the 2008, the performance of all the Sharia compliant indices are better than the performance of conventional portfolio. The conventional portfolio returns are in black, and you see that in these markets, especially USA, Canada, and Europe, the performance of Sharia compliant indices using any standard is better than the performance of conventional index. So conventional index fall more than the Sharia compliant indices. So this is the hedging benefit basically that we were referring to from the beginning. So the popular claims that the Sharia compliant indices perform better, Sharia compliance portfolio perform better than the conventional funds or conventional portfolio. We can see evidence using the nominal returns. Okay, but we don't see that pattern when there is a bull trend in the market. So what we see in those in years after 2008, that SCIs generally lag behind their benchmark indices, and if there is a deviation in returns, the SCI returns deviate from the benchmark returns during the upsurge in capital market, and usually in the upsurge of the market, the SCIs are lagging behind the conventional benchmark indices. So what we did basically, now the descriptive stats give us a little bit hint that there is a hedging benefit, but we still cannot say for sure that there is any hedging benefit or whatnot. And we see that hedging benefit was very specific to the period 2008-2009 when financial crisis has hit the market. So to test it empirically, we use basically 2 models. We use a constant risk model, which is basically the Black 1972 model, in which we try to understand how different are the return of Sharia compliant portfolio as compared with the return, or how sensitive is the return of the Sharia compliant portfolio with respect to the market. But the problem with this model is we assume that the sensitivity, the coefficient of sensitivity that we determine in this model, the beta of the model, is stable over time. But we just have seen in the previous slide that we cannot say that the sensitivity of the Sharia compliant portfolio is stable over the period of time. It goes up and down. So having a model which is so restrictive that assume that the sensitivity of the two indices doesn't change over the time, maybe is too restrictive. So we use another model which is basically a Gauss model, in which we introduce a new term aside from the return of the market, basically, which gives us the return of the Sharia compliant, the comparison of the return of the Sharia compliant index with that of the benchmark, only for the period when the markets are going down. So we use a logistic regression model for that, a logistic function. The benefit of using a logistic function is it is not used as a switch. So normally in the empirical literature we have regime switching model. That means you have a down regime or an up regime. So when you have an up regime and like an on and off button. So either you have a bull market or you have a bear market. But unfortunately the markets are not switches. There is a smooth transition between one state to the other state of the market. So market doesn't change over one day. It may go up and down. So to have that into our consideration, we use this logistic smooth regression autoregressive model. So now I present you the results again without going into too much details, the numbers, just the results directly. We do not find any evidence in general that the Sharia compliant portfolios are any better than that of the conventional portfolios. We do not find any evidence of any abnormal return, except we find that in Canada and GCC the coefficient of abnormal return was negative. So having a negative coefficient means that using the Sharia screening standard, you usually end up with stocks that lags behind the benchmark portfolio. So which is kind of against what the empirical evidences we find using the mutual fund or Sharia compliant indices. What else we find that the return of Sharia compliant indices are very sensitive to the return of the benchmark indices or the beta coefficient. We find that just to give you a little bit sense that if the beta of the model is greater than 1, that means the Sharia compliant portfolio is riskier than that of the benchmark index. If it is equal to 1, that means they both are equally risky, and if beta is less than 1, that means the Sharia compliant portfolio is less riskier as compared with the benchmark index. So we find that there is a statistically significant relationship between the systematic risk coefficient and that of the Sharia compliant portfolio. So what it tells us that we can explain the return of Sharia compliant portfolio with that of the benchmark return. We also see that the Canadian Sharia compliant portfolio exhibited higher systematic risk, while European reports lowest risk. And we can understand the reason for that. See, the Canadian market has very high weightage in the stock of energy, and material and the commodities. And we know that both of these type of company stocks are very cyclical. So that can explain to us why. And when we constructed the Sharia compliant portfolio, we took out the financials. And in the Canadian market, financial has a very high weightage. So you took out a very high weightage stock, a very high high weightage stocks from the portfolio, and what you're left with is cyclical stocks. So that clearly explains that why we have higher systematic risk for the Canadian market. While for the European, again, it's more diversified, and having more diversified portfolio for the European market, we find that the systematic risk coefficient for the European market for Sharia compliant portfolio is lower than that of the benchmark indices. Okay, so now I present you the result for our logistic smooth autoregressive model. And what we see here, that the abnormal return coefficient that we said that was negative for GCC and other market, we do not find it significant in case when we start using the L-star model. So that explains that explains, or that gives us the benefit of using the L-star model. And we also find that for the beta coefficient, the systematic risk coefficient, there was a considerable shrinkage. So that means the beta that was showing a bit higher, that was telling us that the that the Sharia compliant portfolios are as risky as the markets are. We see that the shrinkage tells us that the Sharia compliant portfolios are not as much risky as the benchmark indices are. And the bearish market trend, our down market beta, we generally find insignificant except in case of USA and Japan, where it is negative and significant, while in case of USA using the IOFI standard we find positive and significant, and that basically explained to us whether it is explained to us that there is hedging benefit for investing in the portfolio of the USA. But again, this is not a very robust evidence. It is only for one standard for one market. So to further confirm our results, we thought maybe other factors might contribute to these results. So we use the 4-factor model, which is basically the 2 factors from Fama and French and 1 from the Carhart. And we created again these factors directly from our own data. So these factors, we did not take it from Professor Kenneth's website, rather we have created these factors ourselves, and that we believe is another important contribution of this paper. We do not find any different result than that of our the result that we find in L-star model. Alpha is again insignificant, beta is significant. Down beta market is now only significant for the USA and IOFI market. So to summarize, we find that the SCI, the Sharia compliant portfolios following any Sharia screening criteria, does not result in any performance deviation in terms of the abnormal return as compared to the benchmark indices, despite lower diversifications. The Sharia compliant portfolio generally reflect a lower systematic risk as compared with the benchmark index, and that's why we see the hedging benefit. The Sharia compliant portfolios, when the market goes down, will not go down as much as the benchmark index, but when the market goes up, it will not go up as much as well. So the hedging benefit that we have observed in the previous slides basically is due to the lower systematic risk. It's not due to the Sharia compliance, the Sharia compliance status. The partial evidence of the SCIs investing in the US following the market value equity-based Sharia screening criteria do offer a little bit support for the hedging benefit hypothesis. So in total, we can say that Sharia compliant indices do not necessarily offer hedging benefit during the down market. Thank you very much. I hope I've finished on time. Thank you very much. Thank you. Any questions now?
Now, thank you, Dr. Ashraf, for your informative presentation. Now we open the floor for any question and answer. Also, we would like to invite our audience through the webinar if they have any questions.
My name is Abdul Mahmoud. I'm from ICD. Thank you, Brother Dawood, for a very good presentation. I have one question. You have shown that Sharia compliant indices do not necessarily offer hedging benefits during the down market.
Mm-hmm.
Does the market perceive opposite, or like is it the perception of people is that they provide hedging benefits? That's why you are coming up with the new findings. Do you understand my question?
Yeah. See, the thing is, the reason we started this paper was basically they were. Can you repeat the question for the people for the webinar? Sure. So, what I understand from your question, you want to know whether why we basically have started this research.
Yes.
Whether there is an evidence in the market of hedging benefit for investing in Islamic. Yes. See, the thing is, we started this research basically with the popular claims in the press,
Okay.
saying that if you invest in Islamic equity portfolios, if you invest in the mutual, but basically it was coming from the mutual fund side, that if you invest in Islamic mutual fund, the Sharia compliant mutual funds, you don't have to worry a lot when the markets are going down, and especially in 2008, 2009, when the market dipped like more than 50% in 1 week duration time. So a lot of people have major concerns, and then these guys were showing evidence that look, during this time, the portfolios that were Sharia compliant, they did not fall as much. See, we have to understand that they were not giving you the positive return, but the negative return was not as big as the return of the conventional benchmarks. So that's why the hedging benefit was there, and we did find this when we look at the returns, the nominal returns. We do see that if you look into this markets, the US and this US market or the Canadian or the European market, that in these markets, when the markets went down, this black line, the markets went down quite a bit, while the Islamic, the portfolio that were following the Sharia screening criteria, the Sharia compliant portfolio, they did not fall as much. But we do not find this evidence when we move on into the next. Say, for example, in Canada, the market went down again in 2012 sometime, and we see that we do not find that evidence in 2012. So yes, the popular claim were there, but it was not as much supported with the empirical evidence, or the empirical evidence that we had was basically from the mutual funds again. So the problem with the mutual fund, as I mentioned earlier, is the manager's capability to find the good stock, the stock selection, and the market timing. If the market is going down, he can, whether a stock is Sharia compliant or whatnot, he can sell it off. Well, in case of the portfolios that we have created, we do not buy and sell stocks based on the market. We buy and sell stocks in this portfolio based on the Sharia compliance only. So that's why we did not find the evidence that the mutual fund has found. I hope I answered your question. Thank you. Yes, please. Yes, please.
Thank you very much for your presentation. I'd like to know what is the reason for the low beta of the Sharia compliant stocks?
Can you turn off your mic? Thank you. Okay, so your question is why Sharia compliant portfolios reflect a lower beta, a lower systematic risk. See, if you look into the composition of these portfolios, most of these portfolios does not contain financials, and we know that in the past 10-20 years, the markets are driven by financialization of the assets, and especially the securities of financials. So the financials, when market goes up, they go up higher than that of the market, and when market goes down, they usually go down more than what the market is. So that's why, and the Sharia compliant portfolios does not contain those financials, so that's why they're showing less sensitivity with respect to the market, and that's why we have low beta there. Okay, does it make sense? Okay, thank you.
Yes, further.
Thank you very much. Allow me to differ a little bit from the model you have presented. And the first observation, which I personally have from long back, is that stock markets are not necessarily reflective by justice to the performance of the values listed there. It's rather more under the influence of the mechanics of supply and demand, mechanics of behavior of investor, more than the fundamental value or the fundamental performance of these companies listed in this market. And that's why, obviously, during a downturn, there will be no difference in the performance. And I will give 3 arguments and 3 elements. And I need your opinion. Basically, these indices, or the Sharia compliant indices, are basically in the same stock markets. We don't have separate stock markets for Islamic funds or Islamic companies or Sharia compliant under the screening methodology and the cleansing request. Also, it's the same investors. They are investing in these stocks as well as investing in the conventional stocks. During the crisis and especially if we refer to the 2008 crisis, we all remember that the major aspect was about the liquidity crunch. So the overreaction of all investors across the board was basically following the rule of cash is king. Whoever will have cash, whether investing in Sharia-compliant funds or in conventional equity funds, ETF, they will have the same behavior. And the third element is that Islamic finance itself, whether stock market or Islamic banking or what else, is not living in a silo. So there is a systemic risk. And what else rather than the 2008 crisis is not a systemic risk. So I believe probably if there is a very good research and data processing and benchmarking and comparison, I agree with the first part where you basically challenged the statement of the empirical claims, you called them, and you basically did the math again based on a better methodology comparing the comparables. I do agree on that. But I would like to probably extend the analysis further and include these elements. My point, I do not want your conclusion to be judgmental against the Islamic equity funds, because it's as if you are making a deception or creating a deception here in certain audience who previously were happy to listen to these claims saying that the equity funds Islamically structured are not really affected by the last crisis in the same tone that the conventional equities were. So it's to address that by the three elements which are basically talking about the same nature of investors, the same behavior of these investors during a liquidity crunch, and the same systemic risk impact. Thank you.
Okay. All right. Thank you very much. A very insightful comment, and I absolutely agree with you on each and every point. I do agree with you that we do not have at the moment a market that we can call as the Islamic stock market. Unfortunately, the way things are right now, maybe over the period of time we might have more companies that come up with the status of Sharia compliance, the way the green and the blue companies are right now. So maybe we'll have much better calibration at that time. So the way we did it, basically, we use the best possible data that we have. Now, on your last point that you said that the observations that we had after our empirical analysis that the good returns of the Islamic equity funds. So I think we are rather more boasting it. We are giving them the positive that we did not find, based on the mechanical rules, any evidence for the abnormal return. But these guys are giving positive returns. These guys are producing positive returns. So that basically tells us that our managers for the Sharia compliant equity funds are basically creating a value. So I would look at that way rather than looking at to the bleaker side. Now you have mentioned about the 2008 crisis, and absolutely I agree with you. We cannot say this was a real systemic risk crisis, and it was not in a single market. It was a global crunch, and indeed it was a liquidity crisis. And we know that all the investors behaved at that time the same way. There was panic in the market, but we have to see here, I think there was a little bit difference. I was working as financial advisor at that time in Canada, and I can tell you that I haven't seen a worse time than that at that time, being a financial advisor, like receiving calls from your clients and say, hey, what you have done to my portfolio. I just have looked at it and it shows 50% of the value than just yesterday. So So it happened, but what we see at that time, see the liquidity crunch was created basically by the financials, and that might have been a reason. Some people came out, and then at the same time we had the commodity crisis. So people has to find some other places to invest. So I believe, I haven't looked into specifically that whether people remain invested in those stocks that you might say are the Sharia compliant stock, but I believe the people who remain invested might have been invested in those stocks that were apparently Sharia compliant. Might be. So that could be a reason for having these extra returns during the downturn of the flash. And again, as I mentioned in response to Hassan's question, that having lower beta, you're bound to get lower downfall as compared with the benchmark when the markets are down. So I hope I agree with you with your comments. These are the reality of life. I wish that most of our market, and we are working on a paper in which our basic policy recommendation is that all the regulators, the capital market authorities, especially in Islamic countries, they should bound all the companies whenever they announce their financials. They clearly state that whether these equities are Sharia compliant or whatnot. That will be more transparent and will help a lot of investors to make investments. We don't have to go through that much hassle as we have gone through. I hope I answered your question. Yes.
Thank you very much for this excellent work. Just I have one concern related to how realistically you consider that giving the same weight to all these components, the portfolio that you created, considering that all this component should have the same weight in the portfolio. Because weighting these all different components reflects somewhat different information that sometimes we consider as private information, which is related, for example, to risk, our predictions or anticipation about risk, about liquidity. And this is a part of the management or the manager skills. So I wonder if it's really realistic to ignore all of this or consider it maybe it's not really that rational. But there is some rationality that should consider in the creation of the portfolio, different weightings, that ignoring it and considering that this is not really related, for example, to the market might not really be realistic. I'm not sure about.
Okay. The methodology that we have used for construction of portfolio is market cap based. So that means we're not giving equal weights to all the equities in the portfolio. That's number one. Number two, the private. See, whenever we are dealing with portfolios, we assume the market is efficient. So that means there is no private information. So unfortunately, whenever we are doing any empirical work, we have to have certain assumptions. So in this case, our objective was not to test the efficiency of the market. Our objective was to see whether the screening of stock based on Sharia compliance has any impact on the performance of the portfolios or whatnot. So yes, I agree with you. If we could have a better methodology in which we can incorporate the impact of the private information, it would have been much better. But looking at this one, looking at the information on hand and access to the data, this is the max we could go into the data. I hope I have answered the question.
Thank you very much for a wonderful presentation. I also have a follow-up question. It looks like you have shied away a little bit on macro variables. Can you say your information your presentation haven't touched anything on macro aspects? Because even if you look at the crisis, the 2008 crisis, and other crises before, there were warning signs. And those warning signs probably, I don't know why you did not touch on those things.
Again, see, the assumption of efficient market means the market is taking care of all the macro information. As I mentioned to brother, micro and macro both. So if we are assuming the markets is efficient, it should have taken care of all these factors. Yes, we have taken into consideration some of those factors not mentioned here. Especially, we have used a dummy for the crisis period, because the crisis period we had a big dip. So having that dip, we use a dummy variable to check for that, and we did not find any evidence that the return of this Sharia compliant portfolio was any different during that period. But definitely we did not look into the macro variable. The main reason is we believe the market is efficient and it should have taken care of the macro variables itself. Okay. Yes, please.
The quantitative screening, two components you mentioned. One is the book value,
market value of equity. Yes.
Book value and market value.
Yeah.
Both are allowed by majority of scholars. Like, is it appropriate or is one prohibited?
Okay, so both are allowed. See, as I mentioned to you, the way these standards are developed, these are not purely based on Quran, Hadith, and Ijma. These are derived. So derived mean I can interpret things differently than you can. So for some scholars, as I mentioned to you, businesses are ongoing concern. And I respect both opinions because both have their own weightage. So if you consider the market value of equity, business as an ongoing concern, using the book value of total asset is a better measure to use it. But if you believe that the value of a company is reflected in the market is the right value, then you'll use the market value of equity. And both are endorsed by a different set of Sharia scholars.
But doesn't, if we go by the book value argument, doesn't that open room for distortion? Like, because if there is a, say for example, if there is a crisis, there is a down period, and you still look at the book value, isn't that showing an unfair picture and maybe distorted judgment on that stock or equity?
If you are using an index methodology for construction of your portfolio, in fact, it will give you a bit different picture. Okay, but if you are an active manager, managing your own portfolio, managing the portfolio for your client, then in that case you will look into the market as well. So I do not see a big reason there. See, the thing is, the problem is we believe, or the way mostly investors are, they want to see the value of their portfolio every second. And when you look at that way, use the market value of equity as your screening criteria. But if you are a long-term investor, say for example, if I'm saving for my retirement and I have invested in a portfolio invested for 25 years, we know that market goes up and down, and that's a normal phenomenon. So in that case, it should not have a bigger impact. And I don't think so. It's a distortion. I would not put it like distortion. Maybe is a bit strong word here.
تفضل دكتور زاهي.
Yes, thank you very much, Brother Dawood, for the presentation. Just a continuous comment on the market value and historical value. This is a very long debate on the accounting, but my opinion, the market values, it based on the practice, even more problematic than the cost value, because sometimes it's very subjective. You are make a committee, and committee go to the market and make the evaluation, and this is very subjective. Sometimes it's based on they can give also wrong evaluation. That's why historical value sometimes it will give you also, even based on the crisis, it will give you the directions. It will give you the direction. If there is deviation, is very clear because of this, you can justify it. But the market value sometimes the evaluation, even you cannot justify it. You make a team, and the team go to the market and they say the price is this, like this. And that is based on our Muslim practice, sometimes even very subjective.
Thank you very much. See, the thing is, here we're talking about the public equities. So being in the public equities, we do not face that much problem of valuation. However, when you use the market value of equity, you will face another problem as a fund manager, which is the trading cost. And we know that trading cost is a deadweight cost. So if you're trading more often, your return could not be as good as the return of somebody who's following the book value of asset as an approach for portfolio construction. So that's why in this paper we recommended to our esteemed Sharia scholars, please come up with one standard so that we all can have one peace of mind. I personally favor the book value of total assets. Although I'm kind of indifferent between the two, but I personally favor the book value of assets, assuming that you are investing for long term. Like if you are entering into the market as a day trader, that's speculation, purely. Okay.
We have a question.
The day trading.
Who said it's haram? Just one day. Why it has to be haram?
See, you are using it as a speculation. You are using that the market will go up. So how could you change the value of a company over a day? What are the factors that can change the value of a company over a day? So those are mostly those factors are speculative factors. I would not. Let's talk maybe me and you afterward, but that's my personal view on that one.
There is a question from the webinar. Did you consider any asymmetry of information causing losses to the investors, or did the regulatory transparency have any impact on your findings?
Can you repeat it?
Did you consider any asymmetry of information causing losses to the investors, or did the regulatory transparency have any impact on your findings?
Okay. See, we did not, if I understand the question properly, all these factors, the information asymmetry and regulations, and all these factors, as I mentioned earlier, we assume the efficiency of the market. So if we assume the efficient market, all these factors should have been taken care of by itself. So yes, there could be some concerns, but we did not look into it at all.
I think
another question, if I am the owner of a hotel, did it allow to me to invest 5% of haram?
I'm not a Sharia scholar. This is not in my domain. I cannot say that you can, being a hotel owner, you can put 5% of your investment in haram. If I were you, I would rather put 100% in halal.
I would like to thank you all for your effective attendance, also our dear audience through the webinar, and I hope we'll see you again on our next seminars. Thank you. Assalamu alaikum wa rahmatullahi wa barakatuh.